Hi there, tax accountants. I hope all is well, and I pray that as you are viewing this video, that you're in the best of health and spirit. This video will cover Chapter 3, Corporations, Introduction and Operating Rules from Corporations, Partnerships, Estates, and Trusts, 48th edition. By the end of this chapter, you should be able to compare the taxation of individuals and corporations, list and apply the tax rules unique to corporations, compute the corporate income tax, describe the application of the corporate alternative minimum tax, explain the operation of the accumulated earnings and personal holding company taxes, describe and illustrate the reporting process for corporations, and lastly, evaluate corporations as an entity form for minimizing income taxes on businesses. So we start off with the big picture. We have an individual named Samantha, and she owns Skylark Bakery. Currently, the bakery is operated as a sole proprietorship and generates an annual operating profit of $100,000. In addition, the bakery earns annual dividends of $5,000 from investing excess working capital in the stock of publicly traded corporations. The stock investments typically they're held for a minimum of 3 to 4 months before the funds are required for the business. So obviously, we're not holding them for the long term. As a result of earning income from other business ventures and investments, Samantha is in the 37% marginal tax rate bracket before considering the bakery's operations. In the past, Samantha has withdrawn $50,000 annually from the bakery. This is considered a reasonable payment for her services. Samantha has come to you as a tax professional. She's asking you about the tax consequences of conducting the business as a regular C corporation versus a sole proprietorship. Based on a given information, what would be the annual income tax savings or the cost of operating the bakery as a corporation? And it just states, for purposes of this analysis, we're using the 2024 rates. Ignore any employment tax or any state tax consideration. So as we go through this PowerPoint and we learn the various things about a C corporation, we'll get an introduction to the income taxation. We'll learn about determining the corporate income tax liability, some procedural matters, and also some tax planning as we are doing for Samantha in Skylark Bakery. Because again, being a tax professional is not just about preparing taxes, but you also want to be in a place where you can assist clients, you can empower, and you can educate them, as we will do with Samantha once we learn the basics of a C corporation. So we start with Unit 1, an introduction to the income taxation of corporations. So as we discussed in Chapter 2, there's some distinctions among the various forms of business organizations. We have a sole proprietorship, there's a partnership, there's LLCs, which are essentially an extension of a sole proprietorship and a partnership, but there's a benefit of limited liability protection. We also have an S corporation, which is a hybrid between a partnership and a C corporation. And then we have a C corporation. Then we also have trusts and estates. So there's a distinction between each of these business organizations. So they all have pros and they all have cons. So depending on the objectives of the individual or individuals, that ultimately helps you as a tax professional to be able to advise the client appropriately. So as we move on to Chapter 3, with Chapter 3, we essentially focus on corporations, and corporations are governed by Subchapter C of the Internal Revenue Code. And just keep in mind, whenever you see C corporation, it's essentially referring to a regular corporation. Those terms are used interchangeably. Why? Because we have S corporations. So we move on to the comparison of corporate and individual tax treatment. So when we examine how corporations are treated under federal income tax, it's useful for us to compare how it is treated in comparison to an individual taxpayer. In addition, there are some tax provisions that are unique to corporations. So some similarities is that gross income of a corporation and an individual, they're essentially very similar. It includes compensation for services rendered, business income, gains from selling property, interest, royalties, dividends, etc. And corporate taxpayers, they are allowed fewer exclusions. So we have one here. If there's interest on municipal bonds and life insurance proceeds, there are some exclusions that apply to both. So simply stated, if there's interest or tax exempt interest income, as the name states, it's tax exempt. So it's not reported as income because it's not taxable. Therefore, if there are expenses associated with that tax exempt interest because it's not taxable income, Uncle Sam don't play that, the expense cannot be taken for tax purposes. Likewise, with life insurance proceeds, that's not considered taxable income. So therefore, any expenses associated with the life insurance premiums, they are not considered deductible. If there are non-taxable exchange treatment, it's similar. Gains and losses from property transactions, they are handled similarly. Business deductions of a corporation and an individual, they are also very similar. If it is a ordinary and necessary expense, you can deduct it. Some differences between a C corporation and the individual, different tax rates apply. So one thing we know about individuals, they're subjected to a progressive tax rate structure. So what that simply means, simply stated, the more money you make, the more you'll be subjected to taxes essentially. And depending on your level of income, that ultimately determines what's called your marginal tax rate. And that basically means the last tax rate to which each dollar you earn would be subjected to. And as we know, for individuals, there are 7 tax brackets. Next, corporations, they are subjected to a flat tax rate. So just keep in mind, corporations, much like individuals, used to be subjected to a progressive tax rate. A tax rate used to be as high as 46%. So imagine being a corporation and for every dollar you earn, you have to pay 46 cents to the federal government. And this is not even included the state, right? So from a, logical perspective, if it were still 46%, who would want to form a C corporation? That's expensive. It's expensive to operate a corporation. There were some changes to the tax code, and the progressive rate for a C corporation used to range from 15% to 35%. But with the changes to the tax code, the Tax Cuts and Jobs Act, corporations are now taxed at a flat 21%. It doesn't matter if the net income is $1 million or if it is $1,000 or $100. There's a flat 21% tax rate across the board for corporations. Next, the computations of the alternative minimum tax for corporations and individuals are significantly different. In general, all expenses of a corporation, they are business deductions. The corporation does not calculate AGI. We know that that is specific to individuals calculating the adjusted gross income. Itemized deductions, the standard deduction and the deduction for qualified business income doesn't apply to corporations. We know qualified business income, that deduction was essentially put in place to account for non-corporate taxpayers because again, the corporate tax rate was reduced to a flat 21%. So the QBI deduction was to compensate those non-corporate taxpayers. In addition, individuals are subjected to a limitation on excess business losses, but these do not apply to corporations. So here we essentially see the tax formulas for C corporations and for individuals. So income, as we see broadly conceived, as we know, the Internal Revenue Code does not necessarily define gross income, but simply stated, it is income from whatever source derived. So what that means is that if you are a U.S. corporation and you earn income internationally, Uncle Sam says, hey, you need to report it for tax purposes. From there, you subtract exclusions, if any, you get the gross income. For individuals, there's deductions for AGI. For corporations, there's deductions except for the net operating loss and the dividends received deduction. Then we get what's called our adjusted gross income for individuals. For corporations, we get the taxable income before NOL and DRD. Just so you know, NOL stands for net operating loss and DRD stands for dividends received deduction. So again, just a quick comparison between the two. You can take the time to go through the slide, pause the video, and review it. But for the most part, on the surface, we see that there are some similarities and there are also some differences. But at the end of the day, you get to the bottom line where you ultimately determine, hey, does this corporation have a balance due, a tax due, or are they entitled to a refund? Likewise, for an individual, are they subjected to a balance due, a tax due, or are they entitled to a refund? So there's some specific provisions that are compared. In comparing the income taxation of individuals and corporations, the following key differences exist: accounting periods and methods, capital gains and losses, recapture of depreciation, the business interest expense limitation, passive activity losses, charitable contributions, executive compensation, net operating losses, aka NOLs, and special deductions that are available only to corporations. So as it relates to accounting periods, generally corporations, they have the same choices of accounting periods as do an individual. So we know we have calendar year and then we have a fiscal year. A calendar year is from January 1st to December 31st. A fiscal year is essentially any other 12-month period. They'll think of it from birthday to birthday. So most C corporations, they can use either that calendar year or a fiscal year for reporting purposes. But corporations, they can normally have different tax years from those of their shareholders. So whenever there's a newly formed corporation as a new taxpayer, they can essentially choose what their accounting period is going to be. The IRS does not need to consent to that year or accounting period rather. There is a nuance. S corporations and personal service corporations, which are PSCs, they are restricted in the use of a fiscal year, so just keep that in mind. And just some background: a PSC is a corporation where it's essentially formed to provide personal services. So that could be in the field of law, architecture, accounting, consulting. The services were to substantially performed by the shareholder employees. So that's like if a bunch of me and other accountants, we come together and we start this organization, and 10% or more of the stock is held by the shareholder employees. In such cases, there are some restrictions and limitations. And as a general rule, the cash method of accounting, it's unavailable to corporations except for S corporations, corporations that are engaged in a trade or business of farming or timber, qualified PSCs, personal service corporations, as we just mentioned, and corporations that have an annual gross receipts of 30 million or less. So if they have an average annual gross receipts of 30 million or less for the most recent 3-year periods. In general, whenever a corporation maintains inventory for sale to customers, they're required to use the accrual method of accounting in order to determine the sales and the cost of goods sold. And entities with average annual gross receipts of $30 million or less for the most recent 3-year period, they can use the cash method to account for inventories. And just to ensure everyone understands the difference between the two accounting methods, under the cash basis method of accounting, there's a distinction between the way in which revenues and expenses are recorded. So under the cash method of accounting, what it simply means is that revenue is only recorded when we receive the cash, and expenses are only recorded when we pay for the expense. So let's say there was a job. Let's just say that it's a construction company, right? And the construction company, they built the house and they finished building the house in the month of December. However, they were not paid until January of the next year. Under the cash basis method of accounting, that construction company is not going to recognize the revenue until January of the following year, even though they technically earned the income in the month of December because that is when the work was completed, right? The difference between the accrual method basis of accounting, it does not matter when the cash is received. Under the accrual method of accounting, the key thing is, hey, when did we earn the income? So with the same scenario, the work was completed in the month of December and we did not receive the income until January. Under GAAP governs the accrual method of accounting, and under the GAAP method of accounting, the corporation would need to record the revenue in the month of December. The cash coming in doesn't make a difference. So that's the key difference. Under the cash basis method of accounting, revenue is only recorded when it is received, and under the accrual method of accounting, the revenue is recorded when it is earned. On the flip side, the same thing applies to expenses. Let's say that there's a phone bill, and let's say the phone bill, you use it up for the month of December, but you don't pay it until next January. Under the cash basis method of accounting, you won't recognize the expense until January of the following month. However, under the accrual basis method of accounting, you've used up the phone service for the month of December. Therefore, you recognize that expense in the month of December with no regard to when the payment is made. Next, we see accrual basis taxpayers. Generally, they must recognize gross income no later than a tax year in which the income is included as income for financial statement purposes. Accrual taxpayers, they can elect to defer income inclusion of advance payments for goods and services. So this would be like an example of where a customer pays you in advance, essentially. So in such case, if you were receiving the income in advance, you didn't earn it, right? The customer is just paying you in advance. It is an example of unearned revenue, which is a liability. Lastly, we have related parties. So if an accrual basis corporation has an accrual outstanding at the end of any taxable year with a related party, in such case, it cannot claim a deduction until the related party reports the amount as income. So referring back to the big picture now, we're looking at the difference between the accrual method and the cash basis. So here it says, assume that Samantha incorporates the business as Skylark Bakery Incorporated as a calendar year accrual method C corporation. Samantha, a cash method taxpayer, owns 100% of the corporation stock at the end of 2024. So on December 31st, 2024, Skylark Bakery, they accrued a $10,000 bonus to Samantha. Samantha is not going to receive that bonus in 2025. So therefore, based on what we just covered in the previous slide, they cannot claim the deduction until the related party reports the amount as income. Therefore, Skylark Bakery cannot claim the deduction for the $10,000 until 2025. So obviously, as you see, there are some things to consider when it comes to determining if you want to structure the business as a C corporation or any business organization for that form or for that matter. You want to make sure that you understand the pros and the cons. Next, we move on to capital gains and losses. So capital gains and losses, they result from the taxable sale or exchange of capital assets. Gains and losses, they're classified as either long-term or short-term, and it ultimately depends on a holding period. So long-term, that is essentially for more than 1 year. Short-term, 1 year or less. A taxpayer's short-term gains and losses, they're combined, and then the long-term gains and losses are combined, and the result is ultimately the net short-term capital gain or loss and the net long-term capital gain or loss. So if gains and losses results, these amounts, they're further netted against each other. So for example, the net short-term capital gain and the net long-term capital loss, they're combined. And if instead, let's say there's short-term capital gains and long-term capital gains versus there's short-term capital losses and long-term capital losses, there's no need to, combine it. All right. Because again, as we see here, if it's a loss across the board, then we're basically, there's no extra step. It's only when there's a short-term capital gain versus a long-term capital loss or vice versa. So as it relates to individuals, Depending on the situation, if it's long term, they pay a preferential tax rate of 0%, 15%, or 20% on net capital gains. And as we know, this preferential tax rate also applies to qualified dividends. So, what that simply means is that if there's an excess of long term capital gains over the net short term capital losses, depending on that taxpayer's income, it ultimately determines if they're going to be paying 0%, 15%, or 20% on that capital gain. Net capital losses, on the other hand, they're deductible up to a maximum amount of $3,000. So let's say a taxpayer has a capital loss of $9,000. It will take them 3 years to write that loss off. As we see here, the remainder is carried forward to future years. Carryovers, they don't lose their identity, but they remain as either a long-term capital loss or a short-term capital loss. Now, as it relates to corporations, there's no special tax rate that applies on long-term capital gains. As we know, corporations, they just pay a flat 21%. Entire gain is included in income and is subjected to the normal corporate tax rates. Corporations, they are not allowed to take a deduction for net capital losses. Capital losses, they can only be used to offset capital gains. And any unused capital losses, they're carried back 3 years and carried forward 5 years. And all carried over losses, they're treated as short term. So simply stated, let's say the corporation has a $9,000 capital loss, but they only have capital gains of $5,000. Based on the provision for capital losses for a C corporation, unfortunately, they can only recognize $5,000 of that capital loss. Yes, they have a $9,000 loss, but since they only have $5,000 of a capital gain, only $5,000 can be recognized in a year, and the $4,000 loss is going to be carried back 3 years and carry forward for 5 years, and all of the carried over losses, they're going to be treated as short term. Next, we move on to the recapture of depreciation. So we have what's called Section 1245, and then we have Section 1250. And these recapture rules, they apply both to individuals and to corporate taxpayers. However, with corporations, they have more depreciation recapture treated as ordinary income on the disposition of Section 1250 property than individuals because of the Section 291 recapture. So under this Section 291, a corporation has additional ordinary income that's equal to 20% of the excess of any depreciation recapture that would arise if the property was Section 1245 property over the depreciation recapture computed under Section 1250 without any regard to Section 291. So obviously this could become a bit more nuanced because when you're dealing with property, Section 1245, Section 1250, this is definitely something that a corporation wants to keep in mind. If it is a corporation that has buildings, equipment, things of that nature, they want to essentially factor this in the recapture of depreciation because obviously it's treated different if it is a sole proprietorship or an LLC or an S corp, etc., in comparison to a regular C corporation and the recapture rules. Next, we have business interest expense limitation. There's a limitation on the deduction for business interest that applies to all taxpayers. The business interest is interest that's paid or accrued on any trade or business debt. So what that basically means, simply stated, let's say the corporation has a credit card and they don't pay off the balance every month, so they're essentially accruing interest because of the debt, the credit card debt that they're using. So the limitation, it applies to any business, and the rules, they affect these larger corporations because there's a small business exception. So under Section 163J, the deduction for business interest expense is limited to the sum of the taxpayer's business interest income for the year, 30% of the taxpayer's adjusted taxable income for the year, and the taxpayer's floor plan financing interest for the year. And any amounts that are disallowed, they can be carried forward and then they'll be used in the future tax year. But just keep in mind, this doesn't apply to taxpayers that had average gross receipts for the prior 3-year period of $30 million or less. So, as it relates to the taxpayer's business income, this is basically the amount of interest income that's included in gross income for the year that's related to the trade or business. And all interest income and interest expense of a corporation, it's assumed to be part of the corporation's trade or business, because obviously if you have the credit card, you're using it for business purposes. So using the credit card, acquiring the debt, and paying the interest, it's a part of the normal course of the business operations. As it relates to the adjusted taxable income, this is taxable income computed without any regard to any non-business income, gain, deduction, or loss. It's not factoring in any business interest or business interest income, not factoring any net operating loss, NOL deduction, and it's also not factoring in any deduction for qualified business income, the QBI or Section 199A. Next, we look at the floor plan financing interest. So virtually, this essentially applies to auto dealers. So all auto dealers, they acquire inventory via debt known as what's called the floor plan financing with the debt, and it's essentially secured by the inventory, which is the vehicle. And any interest on his debt, it's deductible without any limitations. And this applies, as we can see, to auto dealers. And these are just some other rules. Flow through entities, and we know flow through entities are essentially S corporations, LLCs, sole proprietorships. Essentially, the business interest deduction limitation applies at the entity level in the case of a partnership or an S corporation, and the partner or the S corporation shareholder, they can deduct the disallowed interest under a special carry forward rule. And with a trade or business, this does not include performing services as an employee, and it does not include certain real property, trades, or businesses, and certain farming businesses. Next, we move on to passive activity losses. So again, we're going through all of the variations, the differences, as well as the similarities between individuals and corporate taxpayers. So we move on to the passive activity loss, and this applies to individual taxpayers, closely held C corporations, as well as personal service corporations. So these rules, they help to prevent taxpayers from incorporating simply to avoid the passive activity loss limitation. So just to give you some more insight as it relates to these passive activity losses. So what it simply means is that they cannot deduct passive activity losses against either active income or portfolio income. So active income, think about it like, you have a job. You don't, if you're hourly, if your salary is obviously a little different, but if you are an hourly employee, if you don't go to work, for the most part, you don't get paid. That's considered active income, right? You need to work to earn that income. Next, we have what's called portfolio income. So that's income that you are essentially earning from investments, your money making money. So that would be like interest, dividends, etc. Then we have what's called passive income. So passive income would be like a rental income, right? You essentially have the rental property, and just the property being in existence and someone leasing it or renting it, that is essentially, you earning income from that rental property. There's not much that you need to do to earn that income. So that would be an example of passive income. So passive losses, unfortunately, well, I wouldn't say unfortunately, but I believe that the reason why this was put into place is because there are a lot of people that were essentially allowing these passive activity losses to offset their active income. And what happens if you have a loss and you net it with income? It reduces your taxable income. Uncle Sam gets paid less, and Uncle Sam just ain't having that. Okay, so you don't lose the passive activity loss. You basically just don't get the benefit in the year. It carries forward, and you get to claim the passive activity loss when you earn passive income. So as we look at this rule with passive activity losses, think of it the same way in which capital losses are treated for a corporation. The capital losses for a C corporation, they are limited to the capital gains for that period. The same thing with passive activity losses, they are limited to passive activity income. Next, we move on to charitable contributions. So with these charitable contributions, both corporate and individual taxpayers, they are allowed to deduct charitable contributions for the year in which the payment is made. However, when we're dealing with accrual basis corporations, they can claim the deduction in the year the preceding payment if there are two requirements that are met. The first is that it needs to be authorized by the board of directors by the end of the year, and it needs to be paid on or before the due date of the corporation's tax return. So that's basically the 15th day of the fourth month. Corporate returns are due the same day as individuals. It's due April 15th, right? So this is obviously different for individuals. Individuals need to make the charitable contributions by the end of the year. Corporations, they can deduct the payment for a preceding year if they meet these two following requirements. So the amount that's deductible for property contributions, it ultimately depends on the type of property that is being contributed. So if this long-term capital gain property, then it's equal to the fair market value of the property. There is an exception rather. So if a corporation donates tangible personal property and it's not used by the charity for its exempt function. So let's say, for example, a charity or a corporation rather, they donate clothing to a homeless shelter, right? So the clothing that they are donating, it's being used for the purpose of the homeless shelter, essentially, providing clothing to those that they are in care of. So in such case, it's tangible personal property, it's clothing. However, it is being used in the charity because of its exempt function, which is helping those that are homeless. The other exemption is that the deduction for charitable contributions of capital gain property to certain private foundations is also limited to the basis of the property. So that's a key thing to keep in mind. Generally, the long-term capital gain property is equal to the fair market value unless the corporation contributes tangible personal property and it's not used by the charity in its exempt function. And as it relates to capital gain property to certain private foundations, it's limited to the basis of the property. So as it relates to ordinary income property deduction, it will be equal to the basis and property. There's an exemption. It will be the basis plus 50% of the appreciation that can be deducted for corporate contributions or the inventory twice of that property's basis. So obviously right now we're looking at the theory. Once you get the chance to go through some of the problems, it'll start to make a bit more sense as you apply these rules. Corporate charitable contribution deduction, it is limited to 10% of taxable income before the actual charitable contribution deduction, before the NOL or capital loss carryback, and before the dividends received deduction, and 15% of taxable income for contributions of food-related inventory. And in the event that there's contributions that are in excess of the 10% limit, then they can be carried forward for 5 years. And in the carryover year, the current year's contributions count first against that 10% limit. So keep that in mind. It carries forward for 5 years. Next, we look at the excessive executive compensation. So whenever there's a closely held corporation's deduction for shareholder employee compensation is subjected to the reasonableness standard of section 162A1. So in general, with this, and there's also a second limitation to these publicly held corporations. But what this essentially states is, hey, they want to make sure that they are paying the shareholder employees not excessive amounts, right? So in general, we have section 162M, and it limits the deductible amounts of a publicly held corporation's compensation to any covered employee to $1 million annually. And covered employees include the principal executive officer, the principal financial officer, and the three other most highly compensated officers. And in general, the 1 million limit applies to compensation, commissions based on individual performance, and performance-based compensation that's tied to the overall company performance. So before 2018, the $1 million limit excluded any commissions and performance-based compensation. And any contracts that were in place as of November 2nd, 2017, they were grandfathered in under the pre-2018 law as long as there was no material changes to the contract. And again, let's think of it, right? You have these corporations and they're making a lot of money. They would essentially take advantage, unfortunately, of these, the compensation, paying, the shareholder employees lots of money. So I believe that this is a provision that's put in place, obviously, to not allow corporations to take advantage. And if we think of, scandals like Enron, and WorldCom, and, companies of this magnitude, unfortunately, they were taking advantage of it, and there was a lot of excessive executive compensation. So a lot of times when there are, abuse of, corporate funds, for lack of a better word, these provisions are put in place, and this is one of them. And just keep in mind, a limitation, it also does not apply to retirement plan contributions or employer provided benefits, which are excludable for gross income by the employee. An example would be healthcare benefits. Next, we move on to net operating losses. So in computing the amount of the corporation's net operating loss, there are some differences. So unlike individual taxpayers, a corporation does not adjust its tax loss for the year for any capital losses. Again, the reason being, the corporation, they can't deduct net capital losses. The maximum amount of capital losses they can claim in a year is equivalent to their capital gains for the year. They do not make any adjustments for any non-business deductions, but individual taxpayers are allowed to. And a corporation is allowed to include the dividends received deduction in computing its net operating loss. Next, we move on to the dividends received deduction. So we know that one of the biggest disadvantages of a C corporation is double taxation. What that simply means is that the corporation, they play a flat, let's just say a corporation has $10,000 of net income. They're paying a flat 21% on that $10,000. And then from that $10,000, they issue $5,000 in dividends to the shareholder. The problem is that when that shareholder gets the 1099 DIV, they now pay taxes on that $5,000 on their individual tax return. Now, the issue comes in to play when there's a domestic corporation that gives dividends to another corporation. So now that gives way for a triple level of taxation. The corporation that has the net income is going to be paying taxes. The C corporation, the shareholder is going to be paying taxes. And then when it's distributed to the shareholders, they're also paying taxes. So to help mitigate that, we essentially have what's called a dividends received deduction. Because again, without this deduction, then it's going to be essentially a triple taxation. So if corporation owns stock at another corporation and they receive dividends, a portion of the dividends may be deducted from income. And it ultimately depends on the percentage of ownership by the corporate shareholder. If the corporation owns less than 20%, then the deduction percentage is 50%. If they own 20% but less than 80%, the deduction percentage is 65%. And if they own 80% or more, then the deduction percentage is 100%. And as we look at, well, we don't cover it in this chapter, but just so you know, when they own 80% or more, then in such case, there's a potential for them to consolidate the tax return. So the dividends received deduction, as we know, it's limited to a percentage of the taxable income of a corporation. And for this purpose, the taxable income is computed without regard to the annual deduction, the dividends received deduction, and any capital loss carried back to the current year. However, The taxable income limitation, it does not apply if the corporation has an NOL for the current year. So again, a lot of this right now is theoretical, but when we go through some of the problems, it'll start to make more sense and you can see how it is practically applied. So as it relates to determining the dividends received deduction, these are the steps. The first thing you do is you multiply the dividends received by the deduction percentage. If they own less than 20%, the percentage is 50%. If they own more than 20% but less than 80%, the percentage is 65%. And if they own more than 80%, then the deduction percentage is 100%. So we multiply the dividends received by the deduction percentage, and then we multiply the taxable income by the deduction percentage. And the general rule is that the deduction is limited to the lesser of the amount calculated in step 1 or step 2, unless deducting the amount derived in step 1 results in an LOL. And if it does result in an NOL, then the individual, the corporation, is able to take the full amount of the dividends received deduction. So here we have this example. We have red, white, and blue corporations. There are 3 unrelated calendar year corporations, and they have the following information for the year. So with Red Corporation, they have gross income from operations of 400,000, their expenses from operations of 340,000, and they received dividends from a domestic corporation less than 20% ownership of 200,000. So based on that information, we calculate taxable income as follows: $400,000 of gross income minus the expenses of 340,000 plus the dividends received of 200,000. The taxable income is $260,000. So we do the same thing for White Corporation. Their gross income is 320,000. We subtract the expenses of 340,000 plus the $200,000. That gives us taxable income of 180,000. And lastly, we have Blue Corporation. They have gross income of 230,000. We subtract the expenses from operations, and then we have the dividends received from the domestic corporation, which gives us taxable income before the dividends received deduction. So we see the expenses from operations and the dividends received is the same across the board. But what is different in each case is the gross income. So that leaves us with varying taxable income before dividends received deduction amounts. So in order to determine the dividends received deduction, we use this 3-step procedure, this method as described above. So step 1, we multiply the dividends received by the applicable percentage, and because they own less than 20%, that is why we're using 50%. So this is straightforward for the most part. 200,000 multiplied by 50%, 100,000. Easy peasy. Now we move on to step 2, and we multiply the applicable percentage, which is 50%, by the taxable income. For the first corporation, their taxable income was 260,000. The second corporation, their taxable income was 180,000, and the last corporation, their taxable income was 90,000. So we multiply each by 50%. Now, for step 3, we take the lesser of step 1 or step 2. And the only time that we take the full amount in step 1 is when subtracting step 1 from the taxable income will essentially yield a net operating loss. So in such case, 260,000 minus 100,000, that would leave us with $100,000. So therefore, we take the lesser of the two. So therefore, the dividends received deduction will be $100,000 for the first corporation. For the second corporation, there's taxable income of 180,000. So 180,000 minus 100,000 would leave us with $80,000 of taxable income. So therefore, we take the lesser of the two, which in this case is 90,000. Now for the third corporation, we have taxable income of 90,000. 90,000 minus the 100,000 calculated in step 1 would yield a net operating loss of $10,000. So even though step 2 shows 45,000, because subtracting the initial amount calculated in step 1 would yield a net operating loss of 10,000, we forget about this rule and the net operating loss exception applies. Therefore, for Corporation 3, we claim the full amount of the dividends received deduction. And again, the key thing when you're utilizing tax software, you input this information and the software does the information, does the calculation rather. But when you're working with clients, again, it's not just about tax preparation. You want to be able to assist them with tax planning. So understanding the nuance and how this works, you will be able to better assist clients as it relates to this dividends received deduction. Next, we move on to organizational expenditures deduction. So under section 248, a corporation, they can decide to amortize organizational expenses over a 180-month period, beginning with the month in which the corporation begins business. So as it relates to the organizational expenditures and amortization, expenses that's incurred in connection with the organization of a corporation, they can be capitalized, right? And what that simply means is that to pay for the corporate charter, any legal fees, anything associated with getting the organization up and running, the corporation is allowed to deduct them, but they are essentially amortized. So when it comes to amortization, just think of it as depreciation, right? Depreciation is recouping the cost over a period of time for a tangible asset. Amortization is more so a form of depreciation for intangible assets. So with this section 248, the corporation, they can elect to amortize the organizational expenditures over that 180-month period. There is a special exception that allows a corporation to immediately expense the first $5,000, but it is phased out on a dollar for dollar basis whenever the expenses exceed $50,000. Organizational expenditures include the following. It includes any legal services incident to the organization, any necessary accounting services, any expenses of temporary directors and of organizational meetings of directors or shareholders, any fees paid to the state of incorporation. There are, however, some organizational expenditures that do not qualify, or some expenses rather that do not qualify. So that includes any expenditures connected with issuing or selling shares of stock or other securities, or the transfer of assets to a corporation. Unfortunately, those do not qualify. So such expenditures, they reduce the amount of capital raised, therefore they are not deductible at all. So here we have an organizational expenditure example. Stork Corporation incurs $52,000 of organizational costs. Stork can expense $3,000 of this amount. How do we determine it? So 52,000 minus the threshold of 50,000, because again, anytime the organizational costs exceed this $50,000, the maximum amount they can claim is reduced. So 52,000 minus the threshold of 50,000 is 2,000. So therefore, the $5,000 that can be expensed minus 2,000 leaves them with $3,000 that can be expensed right away. The remaining balance of 49,000 is going to be amortized over that 180-month period. Next, we move on to startup expenditures. So as it relates to our startup expenditures, these essentially include any various investigation expenses with entering into a new business. So if there's travel, market surveys, financial audits, legal fees, these essentially would be included. This also includes any operating expenses, if there's rent, payroll that are incurred before the corporation actually starts to produce any income. So just keep in mind, organizational expenditures, they are different from startup expenditures. So in general, the startup expenditures, they need to be capitalized, but it can essentially be elected. So at the election of the taxpayer, They can be treated in the same manner as organizational expenditures. Up to $5,000 can be immediately expensed, but is subjected to that same dollar cap. In excess of $50,000 phase out. Any remaining amounts are amortized over a period of 180 months, and this is also available to non-corporate taxpayers. So we looked at some of the key differences between individuals and corporations, and now we move on to Unit 2, determining the corporate income tax liability. So as mentioned, because of the Tax Cuts and Jobs Act, now taxation for corporations, for the most part, it's a bit easier as from a tax planning perspective. It's a flat 21%. So corporate income tax rates, they've fluctuated over the years. The top corporate income tax rate was reduced from 46% to 34% in 1986, and then raised to a top rate of 35% a few years later. And this rate was the highest of all developed countries in the world prior to 2018. So the US corporate income tax rate, with the changes to the Tax Cuts and Jobs Act, it was reduced to a flat rate of 21% for tax years beginning after 2017. Keep in mind, the Tax Cuts and Jobs Act and the various provisions, they are set to expire at the end of 2025. We'll see what happens. It might stay the same, and the provisions might be extended, or we might revert to corporations being taxed at a progressive tax rate. I guess we'll just have to wait and see. So as we refer back to the big picture, assume that Samantha incorporates her business as Skylark Bakery Incorporated, a calendar year C corporation. If the corporation pays Samantha a salary of $50,000 for the year. So in such case, Skylark Bakery would have taxable income of $52,000. How do we determine that? There's $100,000 in operating profit plus the $5,000 in dividends minus the $50,000 of salary expense minus the dividends received deduction. $5,000 in dividends received multiplied by the percentage, because we know there's ownership in the other corporation. So therefore, they get the dividends received deduction, and that is how we calculate this $52,500. So based on this, remember, Samantha, she's in the 37% tax bracket. So we have to factor in all of these different things to ultimately advise Samantha whether or not it's best for her to continue operating as an S corporation, or if it is best for her to operate as a C corporation. So based on this, the income tax liability as a C corporation will be $11,025, determined as follows. The tax on this $52,500, taxed at 21%, is $11,025. So the more we learn about the corporation, the better we can advise Samantha and let her know what her potential tax savings would be if she structures the business as a C corporation. Next, we move on to the alternative minimum tax. So, in an effort to help ensure that corporations, whenever they have significant economic income, they need to pay a minimum amount of federal income tax. So, with that being said, there's a new corporate alternative minimum tax, and this was enacted as a part of the Inflation Reduction Act of 2022. So we have what's called book income alternative minimum tax. So the corporate AMT, it applies to any corporation that has more than $1 billion in average annual adjusted financial statement income. This is often referred to as AFSI for the 3-year period ending with the current tax year. So the corporate AMT is equal to the excess of any applicable corporation's tentative minimum tax over its regular tax, including any base erosion and any anti-abuse tax, which is referred to as B. And the tentative minimum tax is equal to 15% of this adjusted financial statement income for the year, less any AMT foreign tax credit during the year. So as we know, there's some key differences between the individual AMT versus the corporate AMT. Next is some restrictions on corporate accumulation. One of the challenges with operating as a sole proprietorship or a partnership, one of the downsides is that even if you take no money out of the business, you still have to pay taxes on net income. As a C corporation, however, the shareholders, they pay taxes on the dividends that have been distributed, and the corporation pays taxes on the net income. But you can essentially accumulate earnings in the business, which is, the retained earnings. So over the past decades, we essentially see that there's been some changes. And the provisions of the code, they're designed to help prevent corporations and their shareholders from avoiding the double tax on dividend distribution. Because what some corporations will do is that they'll just retain the earnings in the corporation and not distribute any dividends. Uncle Sam is like, not having that. So what the Internal Revenue Code does is it imposes a penalty tax on any undistributed income that's retained by the corporation. So we have what's called the accumulated earnings tax. So what this accumulated earnings tax is described in section 531 through 537, and it imposes a 20% tax on the current year's corporate earnings accumulated without a reasonable business need. So imagine Samantha, right? Samantha has this business. She's already in a 37% tax bracket. She doesn't really need to take out any money from Skylark Bakery. So what she can decide, hey, you know what? Let me just pay the flat 21% on the net income and keep the money in the business. I don't really need any dividends. Uncle Sam don't play that. Unfortunately, if she's just keeping the money in the business and there's no reasonable business need, unfortunately, she'll be hit with a tax. So the burden of essentially proving what constitutes a reasonable need is borne by the taxpayer, essentially. So businesses, they are allowed a $250,000 or $150,000 for service corporations minimum credit in determining the accumulated income. Beyond this minimum credit, the earnings can be accumulated for reasonable needs of the business. So some reasonable needs includes the expansion of the business, the replacement of plant and equipment, if there's working capital needs, product liability losses, debt retirement, self-insurance, loans to suppliers and customers. But reasonable needs of the business, it will not include loans to shareholders, investments in unrelated properties or business, or any unrealistic hazards and contingencies. So it's very important to keep this in mind because, again, if someone is like Samantha and in a high tax bracket and they're saying, hey, you know what? Let me just form this C corporation so that way if I keep $50,000, in the business, I don't need to worry about paying taxes on it. There needs to be a reason why the individual or the corporation rather is choosing not to pay out the dividends. So the personal holding company tax, this is similar. And this was enacted to discourage the sheltering of certain kinds of passive income in a corporation that's owned by individuals with high marginal tax rates. So again, the IRS, they're like the security, right, of tax revenue for the government. So what they essentially do, they enforce and they impose taxes. And one of the key things that the Internal Revenue Service does is they want to help to discourage any aggressive tax avoidance strategies. And as we see here with the personal holding company tax, they wanted to discourage, individuals that are in high marginal tax rates from sheltering these passive incomes in the corporation. So historically, this tax was aimed at incorporated pocketbooks that were frequently found in the entertainment and construction industry. So for example, a taxpayer, they can shelter income from securities in a corporation. They would pay no dividends, and that would basically allow the corporation stock to increase in value. So much like the accumulated earnings tax, these personal holding companies employs a 20% rate, and it essentially forces the corporation to distribute its earnings to shareholders. In any single tax year, the IRS, they can't impose both taxes. So they can't impose both the personal holding company tax and the accumulated earnings tax. Generally, the company is considered a personal holdings company, and they'll be subjected to the tax if more than 50% of the value of the outstanding stock is owned by five or less individuals at any time during the last half of the year. And if there's a substantial portion, 60% or more of the corporation's income is comprised of passive types of income, including dividends, interest, rents, royalties, or certain personal service income. So we move on to Unit 3, procedural matters. And in this section, we're going to cover the various aspects of the corporate income tax return, including some filing requirements, estimated tax payments, and special disclosure schedules on the return. So a corporation, they need to file a federal income tax return, whether or not they have taxable income. So very, very important to keep in mind. If a corporation ceased or if they began operations during a year, you would simply just file what's called a short period return, and that means for less than 12 months. They still need to file it. And corporations, they file what's called Form 1120. Corporations under subchapter S and S corporation, they use Form 1120S. Most corporate income tax return filed after 2023, they need to be filed electronically. A corporation, they need to file Form 1120 on or before the 15th day of the fourth month. So C corporations, they have the same deadline as an individual, April 15th. They can get an automatic 6-month extension. It's available by filing Form 7004, but just keep in mind, the IRS, they can decide to terminate the extension, and they would do that by mailing a 10-day notice to the corporation. As it relates to the C corporations, estimated tax payments. Individuals need to pay estimated tax payments, much like C corporations. So a corporation, they need to make estimated tax payments unless their tax liability can reasonably be expected to be less than $500. The required annual payment is the lesser of 100% of the corporation's tax for the current year or 100% of the tax for the preceding year. There's no estimated taxes again if that liability is expected to be $500 or less. Estimated tax payments, they can be made in 4 installments. April 15th, June 15th, September 15th, or December 15th. We see one distinction between individuals and corporations is that individuals also have April, June, and September, but individuals have until January 15th. Corporations have December 15th. So that's the one nuance between corporate estimated tax payments versus individual tax payment. Next, we move on to Schedule M1, reconciliation of income or loss per books with the income per return. So what this simply means is that Uncle Sam wants to know, hey, why is there a difference between your GAAP income, the book income, the financial statement income versus the tax income? So we have what's called Schedule M of Form 1120, and this is used to reconcile net income as computed for financial accounting purposes, GAAP, with taxable income that's reported on a corporation's income tax return. And these are commonly referred to as book to tax differences. Schedule M1, it's required for corporations with less than 10 million of total assets. And then we'll see we have Schedule M3, which is required for corporations that have more than $10 million of total assets. They don't file both. They either file Schedule M1 or they file Schedule M2. And with the Schedule M1, the starting point is the net income or loss per books. And then we have some additions or subtractions that are entered for items that affect financial accounting and net income and the taxable income differently. So this goes back to intermediate accounting 2, where we learn about deferred tax assets and deferred tax liabilities. So there are some permanent differences and there are some temporary differences. So a permanent difference would be, let's say, tax exempt interest income. So for financial accounting purposes, you would report it as income, but for tax purposes, it is tax exempt interest income. It is never going to be reported on the books. Versus if we think about, let's say, unearned revenue, right? A customer, they pay you in advance. If you are under the accrual method of accounting, we know that that income is only recorded when it is earned. That would be a temporary difference. So it's not reported on the books, but it is going to be reported for tax purposes. Eventually, that temporary difference is going to work itself out. Permanent differences, it's never going to work itself out, right? It's either going to be reported on the books and not reported on the tax return, vice versa. The same thing when it comes to expenses. A temporary expense would be depreciation. Let's say the asset is $10,000. For book purposes, you depreciate it over 5 years. For tax purposes, you take Section 179 and expense the entire thing in the first year. The difference is going to work itself out. You're still going to recoup the $10,000 cost. There's just a difference in timing. Permanent expense would be expenses related to tax exempt interest income. The tax exempt interest income is not taxable. Therefore, you will never be allowed for tax purposes to claim that expense associated with the tax exempt interest income. So this something to keep in mind. And here we see some common reconciling items: federal income tax per books, net capital losses, any income reported for tax but not book income, any expenses deducted for book income but not for tax, and vice versa. And as we pointed out, tax exempt interest and tax depreciation in excess of financial accounting depreciation are subtracted. Next, we move on to the M2. So Schedule M2, it reconciles any unappropriated retained earnings at the beginning of the year with unappropriated retained earnings at the year. So you might be like, what does this even mean? All right. So retained earnings, and one thing to keep in mind with accounting, a lot of times the definition is in the wording in and of itself. So retain means to keep. Earnings is basically, the net between the revenue and the expenses. So retained earnings is the money that's left over in the business, that's kept in the business. And retained earnings, it can be used to be reinvested in the business, or it can be used to pay out dividends to shareholders. So when we have appropriated retained earnings, that means that this money that is retained in the business is going to be set aside for a specific project. Maybe let's think about Apple. Maybe Apple wants to reinvest some of its retained earnings for the new iPhone 30, right? Let's just say they're going to be doing some research and development. So let's say they have $100,000 of retained earnings, and of that $100,000, they want to set aside $50,000 specifically for research and development for this new iPhone 30. The $50,000 that's left over, there's no real purpose associated with it. So that would be an example of unappropriated retained earnings. There's no specific purpose for what that money can be used. It can just be used for general reinvestment, or as mentioned, it can be used to pay out dividends to the shareholders. So with this Schedule M2 in general, the financial statement reconciliation, it's done by adding net income per books to the beginning balance of the retained earnings, and then you would subtract any distributions that are made during the year. And then if there's any other sources of increases or decreases in retained earnings, those would also be accounted for. In the event that a corporation has less than $250,000 of gross receipts and less than $250,000 in assets, Schedule L, which is the balance sheet, and schedules M1 and M2 of Form 1120, they're not required. So the reason being is because for small corporations, this will be a burden, right? So to just kind of, ensure that there's more compliance and less of a burden for these smaller corporations, that is why this rule is set in place. If their gross receipts and assets are less than 250,000, no need to file. It can be done voluntarily, but it's not required, not mandatory. Next, we move on to Schedule M3. So, as mentioned, whenever corporate taxpayers they have total assets of $10 million or more, there's a greater level of transparency that's required as it relates to the differences between income and loss reported for financial purposes versus income and losses reported for tax purposes. So, this expanded reconciliation of book and taxable income is reported on Schedule M3. So Schedule M3, it helps the IRS to identify any corporations that are engaged in aggressive tax practices. And again, it creates greater transparency with corporations like Enron and, the great scandals that took place. These requirements were essentially birthed from a lot of the fraud that took place. Part 1 of the M3, it requires the financial income and net income loss reconciliation reported on M1. So the source of the financial net income loss used in the reconciliation, any restatements of the corporation's income statement for the filing period, any required adjustments to the net income or loss amount. And then in part 2, it determines the reconciliation of net income loss per income statement of includable corporations with taxable income per return. And part three, any reconciliation of expense slash deduction items. So the taxpayer, they need to reconcile the differences between income statement amount, tax return amounts. They need to classify the differences as temporary or permanent, and any required adjustments to the net income or loss amount. And then we have consolidated returns. So this is essentially when corporations are members of a parent subsidiary affiliated group, they may be able to file a consolidated income tax return for a taxable year. And we'll learn about consolidated returns in another chapter. So we move on to Unit 4, tax planning. So we know that obviously there are some differences if it is a non-corporate form of a business organization or if it is a C corporation. So operating as a regular corporate entity, it results in the imposition of the corporate income tax, which we know is a flat 21%. And depending on the situation, this might or it might not be good. Next, we have differences in federal income tax brackets between an individual and a corporation. They're substantial. The corporate source income loss loses rather its identity as it passes through the corporation to shareholders. It's difficult for shareholders to recover some or all of their investment in the corporation without an ordinary income result. Corporate losses, it can't be passed through to shareholders. That's something to keep in mind. So for a business that's starting up, I actually had a friend reach out for some advice for a client, and he was, thinking about setting it up as a C corporation. It's a new business. It has small amounts of profits and potentially losses. So, I had to let him know what would be the purpose of setting it up as a C corporation. If there's a potential loss, the shareholder, the owner, is not going to get the benefit of the loss if it's structured as a C corporation. So, since the business is in its, small infancy stages, this is the only income for the individual. It would make more sense for them to treat it as a sole proprietorship or an LLC. And when the profits are going to be generally higher, then it might make sense for them to structure it as a C corporation. So again, it's not a one size fits all kind of thing. It's ultimately dependent on the individual's tax situation as well as their objectives. Next, liquidation of a corporation will generate tax consequences to both the corporation and the shareholder, something to keep in mind. The corporate form provides shareholders an opportunity to be treated as employees for tax purposes. So, operating a corporation, there's some effective tax planning that can produce large deductions. Obviously, the timing of capital gains and losses, planning for the business interest expense limitation, charitable contributions, executive compensation, NOLs, the shareholder employee payment of corporate expenses, personal service corporations, and avoiding the accumulated earnings. Because again, yes, the challenge with a S corporation or a partnership or LLC and S corporations that all of the net income is going to be subjected to tax in some way, shape, or form. The C corporation can retain some of it, but now you need to factor in if you're accumulated this income for no reasonable purpose, Uncle Sam is not having that. Don't play that. You're going to be subject to that 20% tax. So now if we go back to the Skylark Bakery, we're refocusing on the big picture. So conducting Skylark Bakery as a corporation, it would ultimately save Samantha $8,475 in income taxes annually, computed as follows. So as a tax professional, this is where you provide value to clients. They want to save money legally. Tax avoidance is legal. So if she operates the bakery as a sole proprietorship, based on the original fact pattern, the operating profit was $100,000. So we know she was in a 37% tax bracket. 100,000 times 37% is 37,000. She received dividends of 5,000 from the corporation because of her income. The dividends are taxed at that preferential rate of 20%. So 5,000 times 20, 1,000%. There's no tax on the withdrawals of 50,000, so therefore $38,000 would be the tax as a sole proprietorship. If we compare it to the C corporation, the corporate taxable income as we calculated previously was 52,500 multiplied by the 21%, which is 11,025. Samantha's salary of $50,000 would be reported on her individual tax return, taxed at 37%, which would be 18,500. So her total income tax when operated as a C corporation would be $29,525. Right? So we compare that to the 38,000, she would save about $8,500 each year. And again, this is how we calculated that 5,200, $100,000 in operating profit plus the $5,000 in dividend minus $50,000 of salary paid to Samantha less the dividends received deduction, which gives us that $52,500. And just keep in mind, if available, the deduction for qualified business income would reduce Samantha's $100,000 proprietorship operating profit, and ultimately it would reduce the tax savings of incorporating. So something else to keep in mind. The example, it illustrates the tax savings available when a high income individual takes advantage of the lower corporate rates. However, as we know, there's some other things to consider. Employment tax considerations, because as a employee, they're going to be required to pay payroll taxes both at the corporate level, the employer, and the employee level. The deduction for qualified business income is not available for C corporations. The taxation of dividend distributions, income taxes, and the additional Medicare taxes on net investment income, depending on the income. And then further, there's some other potential entity options such as an LLC, an S corporation, which should also be evaluated. So here it states, what if? What if the bakery in the first year becomes a corporation and generates a $10,000 short-term capital loss on the disposition of some of its stock investments? Regular corporations, as we know, they can only deduct capital losses against capital gains. Thus, the $10,000 short-term capital loss is not going to be deductible. Instead, it'll be carried forward 5 years. If the bakery operated as a sole proprietorship, Samantha would be able to report the capital loss in her individual return, but we know that it will be limited to $3,000 per year. So again, when it comes to tax clients coming to you for advice, you want to look at the various business structures from a holistic perspective. What are their objectives? Are there going to be losses in the first few years? What's the longevity of the business? Because you don't want them to set it up as a C corporation or even an S corporation and they can't afford to pay payroll. So there's a lot that needs to be considered before advising clients. So this brings us to the end of chapter 3, corporations, introductions, and operating rules. So now that the lesson ended, you should have learned to compare the taxation of individuals and corporations. So we know there are some differences with which charitable contributions are treated for individuals and corporations. There's some differences as it relates to how organizational expenditures are allowed. There's some differences with business interest and things of that nature. Net operating losses and things of that nature. There are differences. There's some similarities, but then there's also differences. We also considered some of the rules that are unique to corporations. A very big one is the dividends received deduction. We learn how to compute the corporate income tax. We know that it is a flat 21%. We describe the application of the corporate alternative minimum tax. We explain the operation of the accumulated earnings and personal holding company taxes. Again, Uncle Sam knows that some individuals, especially the high income tax earners, what they would do, they would essentially just start the corporation, leave the profits in the company. Unfortunately, not happening. If it is being held in the corporation, they're accumulating the earnings without a reasonable business need, they'll be hit with a 20% tax. We described and illustrated the reporting process for corporations. They file Form 1120. It is due April 15th. Unless their tax liability is reasonably expected to be less than $500, they need to pay estimated taxes in 4 installments. April 15th, June 15th, September 15th, and December 15th. And lastly, evaluate corporations as an entity form for minimizing income tax on businesses. And again, when you advise clients, you want to look at it from a holistic perspective and factor in the pros and cons of all of the various business structures. So again, this brings us to the end of chapter 3, Corporations, Introduction, and Operating Rules.